Hello and welcome to the lecture for part 1 of chapter 22. Chapter 22 gets into the subject of budgeting, which pretty much every organization, whether it's a not-for-profit or a state agency or a private business, is going to have a budget. At least they should. So we'll talk about how budgets function. I'll give a bit of an introduction to kind of big picture issues about budgeting, and then we'll get into the nitty-gritty of it. And we'll probably get through the first 4 learning objectives or get started on operating budgets. And then the second part of the lecture will finish up operating budgets and get into financial budgets, which are a little bit more complicated. So the key thing that, then the book doesn't really address this, but I want to share it with you just because I think it's important based on my personal experience. All budgets should start with what the strategic plan for the company is. So a lot of companies make the mistake of saying, well, we need to do our budget for the upcoming year. Well, let's just take last year and add 5% or something like that. And it ends up being, not very meaningful or useful. Instead, it should start with a discussion about where does the company or the organization want to go? What big picture goals do we have that we want to shoot for? Do we want to start selling internationally and get into other markets? Do we want to add new products to our product line or change our business in some way? Maybe start producing product ourselves versus having other people produce it for us. Whatever the goal is, that should really be the starting point, and that should drive the rest of the process. So the first step, once goals have been determined, is to establish specific goals for each area within the company. So as an example, if we want to expand into the South American market, well, there's goals and specific things that each department within the company needs to accomplish in order for that to happen. So laying all of that out. The next step is executing those plans, doing the things you agreed you would do. And then the important part is comparing actual results with where we thought we were going to be, so we know, are we on the right path or have we deviated from the path? Now, the budget isn't chiseled in stone. Just because we deviate from the budget doesn't necessarily mean it's a bad thing. It could mean that maybe the world has changed and our original plans are no longer meaningful and we need to change those plans. But at least it's a warning sign that, hey, we agreed we were going to do this and it doesn't appear we're doing it. So here's another way of looking at it. So planning is saying, what should we do, right? What goals should we have and what do we need to do to accomplish those goals? Directing it is actually taking action and telling people to do certain things and giving employees instructions and laying out what needs to be done and getting it done. And then the third step is controlling. It's comparing the results to budget and saying what's going on here. This is an area where I would make the argument that coming in under budget isn't necessarily all good. Say as an example, in that case where we want to expand our products into the South American market, we might need to hire a team of engineers to go through all of the safety requirements of our product in other countries. Well, if somebody is under budget for engineering salaries, it may mean that they haven't hired those engineers and they haven't started that work yet. So even being under budget could be a warning sign. A lot of companies take approaches to budgets that cause problems, and I want to kind of lay those out with this graphic from our textbook. So in the first case on the left there, budget goals are too tight. That's demoralizing. Nobody likes to work somewhere where you're constantly coming up short and failing in the eyes of upper management. So that's not good to have things that are too tight. That doesn't serve anybody's purpose. On the other extreme, having budget goals that are too loose, that are easy to make, I've heard that called sandbagging, that's not productive either. The other problem would be conflicting budget goals. If you were in charge of a call center and I told you I wanted you to double the number of calls that you were receiving and improve your quality marks with all of the people that you were talking to on the phone, it's hard to do those two things at once. One type of budgeting that is very useful is called continuous budgeting. So rather than budget for a year and then you come to the end of that year and see how you did and then you start a budget for the next year, This is always having a period of time ahead of you where you're looking down the road. When I did this in the real world, rather than doing a 12-month budget, a rolling budget like this, I did 4 quarters. So I wasn't going down quite into the level of detail. But if you don't do that, then what happens is, say you're on a calendar year and you've done a budget for this calendar year. Well, when you get to November or December, you don't really have a view as to what January or February is going to be, and you might need that for planning purposes. So this is a really good thing to do. So different types of budgets. So a static budget is a level of expected spending for a particular department, and it's not connected to some kind of level of activity. So this may be for a research and development department or for a marketing department. So what is it that they're going to do? And that's really kind of irrespective of how much we're selling or what production is being done. So a flexible budget, which would be more for production areas, is going to show what the results would be at different levels of activity. And in order to do that, we'll need to divide things between fixed and variable, and we'll need to take mixed cost and split them into fixed and variable. So we could determine what the costs are at each activity level. Well, this would be important. You think if you're a production manager in a factory, and you based your budget, say your company does a static budget, and you based your budget on doing 10,000 units of production each month, and your spending is based on that 10,000 units of production. Well, one month is really busy and you end up doing 13,000 units of production. Well, you're probably going to spend more on direct material, and you'll probably spend more on labor and all of that. Should somebody look at you and say you've done a bad job because you've overspent? No, that's kind of silly, because your spending is connected to your volume. So flexible budget allows you to say, no, I produced more, which means I should have had higher cost, and at that I was within budget. So here's an example of a flexible budget. So they've got 3 different levels of units of production, 8,000, 9,000, and 10,000. That's the first step. And then you can see we've got a variable section. Those are all changing. So direct labor is $5 per unit. They've done that math. And so we can figure out for 8,000 units, that's $40,000. It goes up to 45 and then up to 50 for 10,000 units. Same thing with electrical power. Now, electrical power, it appears here, was a mixed cost. So this is the variable portion of electrical power, which is tied to the number of units. And then they've got the fixed portion of electrical power down below in the fixed portion. And you can see the fixed portion, the 1,000 for electrical power and the 15,000 for supervisor salaries, those don't change regardless of the level of production. So in this case here, let's say we had built the budget on 8,000 units, but really they did 10,000 units of production. We really should be looking at their spending and say, how did you do relative to 71,000 in spending, not 60,000? That's a more fair judgment of how they did. And this shows an example of that you could be in a static budget, you could be seen to be over budget, but when you look at it on a flexible basis, you actually did better. So a master budget really is a collection of budgets that are all connected to each other, because spending and volume in one area is going to affect what happens in other areas. So I'll talk about each of these budgets in turn. We'll at least get down through the direct material budget in this lecture. So the first ones are going to compile my budgeted income statement, and then the financial budgets will help me with a budgeted balance sheet. So the process starts with a sales budget. It starts with, what do our sales management and our salespeople in the field believe is going to happen? And it's really important that that's as realistic as possible. It's really common for sales management to kind of get stars in their eyes and think of big numbers and large growth, and that's just kind of how those people are wired. The problem with that is then you go through this whole process of building a budget on 30% growth or something crazy. And then when that doesn't happen, then there's all kinds of budget cutting that needs to take place, and that's not productive activity for anybody. So having a realistic sales budget is important. So that sales budget is going to drive the production budget. What do we do? What are we going to make? That production budget is going to drive how much material we need to purchase, how much labor we need in our factory, and how much overhead we're going to have. That's going to give us cost of goods sold. Then I combine that with selling and administrative expense budgets. That'll give me the complete budgeted income statement. So in this case here, the sales budget is shown both in units, and you can see we've got two different products here, wallets and handbags, that we sell in the East and sell in the West. So I've got volume for those, the prices, and the total sales. So based on this for a full year, again, in the real world, a company might do this monthly, of course, to have 12 figures. But they believe that for next year, they're going to have a total revenue of $13,336,000. And it's important to have the details supporting that number because we need that information for other parts of this budget. So the production budget is integrated with the sales budget. So it's based on units of product that have been budgeted to be sold, but it's going to take into account what the inventory strategy is. So do we want to build up inventory during this particular year? And again, it could be during months. Or do we want to work down inventory? So we will have a policy about whether we want to build or reduce inventory. So why would you want to do something different than just make what's going to be sold? Well, as an example, I may be nervous about supply chain issues in the upcoming year, and I may want to build up some inventory so that I can still meet my customers' needs. Okay, that may be one reason I want to build up inventory. I may have cash flow concerns that are causing me to want to reduce my inventory, and maybe I'm thinking about ending a product at some point, so I want to work the inventory down. So that may be a reason as well. And I may want to have kind of, and this especially gets to if we're doing it on a monthly basis, I don't necessarily want to work all of my employees in the factory overtime one month and then lay half of them off the next month if I have peaks and valleys in my sales. So I may want to overproduce one month and then underproduce the next month so that I can have steadier production in my factory. So the formula that I'll get to say how much do I actually want to produce is I'm going to start with the units that are going to be sold, and I'll add where I want the desired ending inventory to be, and I'll subtract where I estimate the beginning inventory will be. So if I'm going to be increasing inventory, that means I'll be adding a number to units sold. If I'm going to decrease my inventory, I'll be subtracting the sum of that plus minus lines. That'll give me what I'm going to produce. So here's an example. So for wallets, we expect to sell 528,000. That was from the sales budget. We want our ending inventory of wallets to be 80,000. We think we're going to start the year at 88, so we're going to work our inventory down by 8,000 wallets. So we only need to produce 520. We don't need to produce the full 528 we're going to sell because we're going to consume some of the inventory. The case with is the opposite with handbags. So we're going to sell 280,000 handbags. We want to end with 60,000 in inventory, but we start with 48. So here we're going to produce all the 280 we're going to sell plus another 12,000 for 292. So that's how the production budget is going to be only no dollars, just in units for each product, and it's going to correlate to what our strategy is in that case. So the next step I want to talk about is the direct material budget, and that's based not on our sales budget but on our production budget. What are we going to produce? That's what we need to buy material for. It'll also take into account our inventory strategy. So do I want to build inventory up or do I want to consume inventory? And again, that could be influenced by a number of different business factors, but there could be some rational reason for wanting it to go up or down. Sometimes there are conversions that need to be done. As an example, maybe my bill of materials or the recipe for making the product calls for ounces of material, but I need to convert it to pounds when I buy it. So you have to be a little bit careful about what kind of units of measure are being used. So here's an example of a material purchases budget. So we had what we need. You can see the notes down below. We're going to produce 520,000 wallets, okay? And each wallet needs 0.3 square yards per unit. For leather, and for lining, it needs 0.1 square yard per unit, okay? And then note B has that same information for the 292,000 handbags we're going to make. So I have one column for leather, one column for lining. I would have a column, you see C and D there, for as many materials as I have in those particular products. So again, I'm adding, if we just look at the leather column, I need enough leather, 156,000 for production, square yards for wallets, and 365,000 for handbags. And I want my ending inventory to be 20,000. I believe I'm going to start with 18,000, so I'm going to be building up 2,000 square yards of inventory, increasing my inventory. So I need to purchase 523,000 square yards at $4.50 a yard. That gives me the dollar amount that I'm going to use to be able to purchase that. So your homework will take you through this, and I'll post a video practice for one of the homework problems that should be helpful to you as well. If you have any questions, please shoot me an email. I look forward to talking to you, and I'll talk to you next in part 2 of the lecture for this chapter. Thank you.